I genuinely think that 90% of failure all comes from the same, no more than 10 patterns maximum. You look at a really successful company and see how they did things. In my view, it's next to impossible to replicate that. But when a company fails, that's all replicatable stuff that we didn't pay enough attention to.
Toby signs off on his investor updates and it's like going homeless or going somewhere. I just love that.
These are the 10 startup lies. I'm a Forbes 30 under 30. What it actually means is I paid a PR firm 50 grand so my mum could be proud of me.
They listened to him, did what he said, and now he's suing them for doing it. But it is a reminder for founders of how litigious, trigger happy they are in the US. And we talk about this with trade missions and preparing founders for different markets. But in the US, it's like default litigation.
Good morning.
Morning, boys.
Morning, guys.
It's the middle of August and it's monsoonal, and I'm going to have to do a lot of editing to this episode to get rid of that sound of hissing down rain at the moment. I don't know what's happening. I think it's because we organised an event at my place in a couple of weeks.
Yeah.
And now the universe has said, all right, I'm going to bring you the tribe weather.
I think with the number of events that we've organised this month and early into next, and the fact I have a wedding coming up, it was funny. I reached out to a wealth manager and we were chatting about Tribe. He goes, I'd love to come to one of your events. Like, all I know about them is there's always some insane weather event and you guys bring this monsoonal downpour. I'm like, yeah, that's us.
Without wanting to get too graphic, we're in the process of doing some renovations, which is not ideal because it's a mud pit. But with this amount of rain and the change we had to do in the plumbing, it looks like the septic system has overflowed.
Tribe always delivers a memorable event.
Yeah. If you're in the parking area and you drop some food, no 10-second rule. So what have we been up to? Jack, have you settled on your new house?
No, not yet. So we settle on the 21st of August.
Oh.
So I've got a few more weeks. No, I was quite happy to hear you don't start paying repayments until the month that after you sign. So very, very happy that we get an extra month.
That's when you know you're flying close to the wind, when that extra month brings you joy. Welcome to the mortgage belt, my man.
Oh, I love it, Jack. I love it. And Jack, you got to give a rugby update. I feel like it's the most questioned part of responses from listeners.
So we had 1v2 quarterfinal. We lost by 7 points, same amount of tries, but 2 missed conversions and a penalty. So then the team that we lost to, they go straight through to the grand final. We go on to the semifinals. We go up against another team this week. If we win that, straight through to the GF.
If you don't make this grand final and win it on my wedding day, I'm going to be incredibly disappointed.
I know there's a lot riding on it. Like it's, but no, it's good. We got a lot of boys back. Like last night at training, it was good. So no excuses now.
So have you got your captain's motivational speeches? Have you watched Any Given Sunday, all of those kinds of movies to...
Can't done, you know me. Definitely haven't watched it.
You've got a life.
I love it.
Aaron?
Yeah, I had a good overnight with some mates on the weekend. That was nice to get away, and not quite a bucks party, but exactly what I wanted in a bucks party, which is time around a campfire. So that was good. And then I've come back to a house full of sick kids and everyone's falling at the moment. So that's not fun.
I've recovered mostly after last week, but then it triggered my asthma. And then yesterday's like, okay, well, to keep you up with your training schedule, I'll put you on prednisone. And I think you've dealt with me when I'm on prednisone. So there's a lot of words, a lot of energy. I did 2 hours on the bike this morning, but for the next 3 days, apologize for the annoyingness that prednisone sends me to.
It's going to be fun. That sounds just normal for you, Don. You had a Venture Crowd dinner last night too.
Yeah, Venture Crowd invited us to dinner. I got to meet Dan Gabble of Black Sheep for the first time. I was really excited. We compared some notes with some common interests, so that was awesome, and got to meet some new people. And that whole venture crowdfunding space, the way they're approaching it is they're looking at both VC, property, and private credit. So they're going into three verticals. It was interesting to hear what people had to say about different parts of the market, what people are seeing in deal flow, all the same stuff we talk each week. We're still in a deep trough, and those with the best returns and the best value proposition will float to the top.
Yeah. But awesome you got to meet Dan. He's such good value.
Oh, so good. And he, like, when people would say something that clearly either was half thought out or not correct. So, i.e., most stuff out of my mouth. He was very quick to jump in and engage and call out the bits in the argument that needed more thought. So that was great.
Yeah, he's not backwards and going forwards, but a bloody good guy.
Let's jump in. We don't have anything to recap from prior episodes, but I thought we would just start with just a bit of lunacy and stupidity to kick us off on such a fine day. Elon Musk is suing advertisers that boycotted him.
This was hilarious. Oh, just reading this. Of course. That's all I have is, of course, he is.
X claims they deprived it of billions of dollars in revenue. Legal experts say the case is unlikely to succeed as any collusion or agreement between companies will be hard to prove. The lawsuit relates to this period of 2022, just after Musk bought X, then known as Twitter, when advertising revenue died. So Mr. Freedom of Speech is learning that freedom of speech does not mean freedom from consequence. And then, like all good narcissists, despite his own behavior, he doesn't want to take accountability for it. He wants to blame others and make others pay. And that's the lesson that I've learnt, is the way that the narcissist likes to operate.
Oh, the irony of the man who stood on a stage telling advertisers, get fucked if they don't agree with him. And then
go fuck yourself, I think were the actual words. I might just cut that in here just to remind you of the words that were said.
I hope they stop. You hope, don't advertise.
You don't want them to advertise?
No.
What do you mean?
If somebody's going to try to blackmail me with advertising, blackmail me with money, go f yourself. But go yourself. Is that clear? I hope it is. Hey, Bob, if you're in the audience.
Well, let me ask you then.
That's how I feel. Don't advertise.
So, yeah. So I think it just turns out that the advertisers decided to go and fuck themselves, didn't they?
Yeah. They listened to him, did what he said, and now he's suing them for doing it. But it is a reminder for founders of how litigious, trigger happy they are in the US. And we talk about this with trade missions and preparing founders for different markets. But in the US, it's like default litigation.
Yeah, I think we were talking to Jason Seed about it a few months ago. In Australia, you get together, there's a bit of a problem with the client, you go and have a bite to eat, you talk it through, you try and work through it. In the US, without any, it's not like angst or anger or whatever else, it's just, oh, this isn't working out, I'll send it to the legal department. And then the lawyers take over, and that's the way things are handled. And a lot of founders get really surprised, upset, and lose a lot of money because the way they do business over there is different to here.
And the emotional heartache, if you're not used to that type of culture, it's challenging.
I just appreciate that you were able to segue into this to actually add some value to people, Aaron, rather than just being a random rant. So that's nice.
Always trying to add value, even when it's about Musk.
You got anything to add here, Jack, or are you going to be professional and sit in the corner?
I'll take that option.
Wise man.
Let's get to stuff that's more local and more relevant. There was an article during the week, which I think just carries on the theme of transparency and honesty in terms of the reality of what's happening at the moment. This article's by Bronwyn Clune, called Quiet Exits. Startup M&A happens more often than is reported. Whilst VCs tell us an exit is an exit, Flippa's CEO says that he's been told not to publicise them because they don't fit within a narrative. There are two main types of exits. The first is the kind that VCs are eager to talk about, the ones that usually involve life-changing outcomes for founders, big returns for limited partners in the venture funds. The second, let's call them the quiet exit, often flies under the radar and in some cases is never actually announced. This kind often involves a good business led by talented people that reach a phase where when they are no longer able to generate outsized returns and attract future venture capital. Sometimes it's more of an acqui-hire or a distressed sale type scenario. These quiet exits happen more often than many watchers in the ecosystem may realize.
Yes, a quiet exit. I think there is a distinction in here. There's the term I heard another VC use is sunsetting, like these ones that are actually more like a loss, that are acquired for their IP or for their customer book or something else and return cents in the dollar. But yeah, these small exits, I'm thinking of some locally here in Queensland that never got talked about much. The founders still do well enough. It's not a complete life-changing event, but significant enough to set them up for whatever they want to do next. We probably should celebrate them more, but also, I don't know, I do have a bit of a reaction of, do we need to celebrate these things? I am an advocate of storytelling, but the results speak for themselves.
The results, how do the results speak for themselves if we don't tell anyone?
Well, that's true. I think the distinction is, if they're being told, don't talk about it, I find that weird. Like,
Yeah. I mean, this is transparent VC podcast. And now that we've told all of our LPs, without mentioning any names, we've got a quiet exit, our first one that's occurring. Founders tried hard. We still believe that there's an underlying problem. The market rejected, wasn't able to get traction. And now we've been working with them in partnership with some partners on our side. Big shout out to Interfinancial, who, if you're looking to sell a business or acquire a business, Sharon and Mark and the rest of the team are really great to work with. Just as we've seen with this one, they went out to their international network, and now there's potential people looking at it, from the US, India?
Yeah, from India, South Africa, US. Yeah, phenomenal. Their network is just phenomenal. Yeah, and for founders, having people like that with that sort of experience in the network and back pocket is just so valuable.
Yeah, so we've got our own, because there's some commerciality stuff, and it's not that they've just turned off the lights. They're still trying to run a business, but they've just accepted that actually the current conditions don't allow enough runway, and it would be better off being some part of something else. And when the business is sold, I think we will probably still announce it as we would normally anything else through our investor networks, but we're probably not emailing journalists, because yes, it's true that some VCs want to hide it, and I just find that a little bit daft, because if you want to attract more LPs, I think you have to normalize that this game is a game of some wins, a lot of losses. And if you don't talk about the losses and how some of those losses are mitigated, how are you going to find new investors? But at the same time, the media is not interested in a mediocre return story either.
Yeah, it is interesting that notion of hiding them. We did a post-mortem on this one, right? And we shared it with our active investors and shareholders. And it was interesting hearing one of our larger shareholders and investors. He said it was incredibly valuable, but his comment was, other VCs don't do this. And that feedback's super interesting. But I think it is a point of difference. We are very transparent.
Yeah, he was a bit worried for us, I think.
Yeah.
I was surprised. I just didn't think sunsetting companies would actually use a company like Flippa to try and offload these companies. I was quite surprised by that. But it makes sense. But then, yeah, quite interesting how they frame it as doesn't fit the narrative. From a media or a PR point of view, I can understand that. But from an investor's point of view, like, the game we're playing here is trying to find outliers. So you've got to get comfortable taking the risk and accept that 8 out of the 10 could fail, but the 1 or 2 will return the fund and some. So it's just the reality of the game we play. But it could just be the difference between the media team and the investment team there in terms of the narrative.
So at dinner last night, we were just talking about sunsetting and failures, and I said, we've started sending pre-mortems out to our portfolio. And I said I did one live in front of the entire team, and it was a fascinating conversation. The beginning was like, so for the companies that have died, you've told them. I was like, no, these companies are still alive. Oh, but they're like really failing. No, they're doing really well. And you tell them why they're going to die. I hope you say something positive to them as well. It's like there's 364 days for positivity. One day of the year, we're going to read out, we are gathered here today to mourn the loss of X company because they didn't do this. They did do this and they shouldn't have, whatever it might be. It's taking that information in a certain way and trying to really get them through the eyes. Now, we could be wrong and we don't ask for a response, but it's just trying to frame up from our perspective on the outside, because when you're in the painting, it's hard to see the whole picture. So when you're a founder in the trenches, like, it's hard to see these things. We're just saying, look, if you were to die, it's probably because you couldn't get this happening. And this challenge over here, you weren't able to solve. You ignored this for too long and this happened.
It's interesting. The default assumption is that a pre-mortem is bad, as in it's not nice for them to hear, but yeah, it's tough for them to hear. But I actually think it's the most valuable thing for them to hear. That the pleasantries and reinforcement purely of the positive adds little value that's actually going to shift the needle.
And talking with the founder that I did the one live, I had a conversation afterwards. It was like, because the way I framed part of it was like, you weren't strong enough to resist this impulse. Like, that's a fairly aggressive kind of thing, but that's often what's happening with entrepreneurialism, right? They've got a series of impulses, and you've got to work out which is the impulse that I'm going to run with and which is the impulse I'm going to resist. And often the things that kill companies time and time again, we couldn't resist the impulse to do X when success is clearly demonstrated by Y.
Since we mentioned it on the potty, was it last week or the week? I can't remember, but I've had all these founders reach out asking if we would do it for them, if we do it as a service.
Pre-mortem as a service.
Yeah. Yeah. Like they're
It's like Seinfeld Festivus.
Yeah.
It's like, I've got a lot of problem with you people, and now you're going to hear it.
But it obviously resonated with some of the founders because they're like, I love this idea. Can you please do it on us?
I genuinely think that 90% of failure all comes from the same, no more than 10 patterns maximum. The problem is the patterns of success, whilst can be seen in hindsight, are really hard to replicate. You look at a really successful company and see how they did things. In my view, it's next to impossible to replicate that. But when a company fails, that's all replicatable stuff that we didn't pay enough attention to. And that's all we're trying to bring to the service in a stronger light. Now, the reality is it's hard for founders always, and it's hard in the current market. And there was an article in Capital Brief by Kate Burgess talking about Sircel, spelled Sircel. The article says, shunned by banks and major funds, Sircel managed to secure $5 million in patient capital early this year. It has big ambitions for its chemical-based technology that aims to keep e-waste out of landfill. It's simple enough to crush a used electronic device and extract some of its metallic components, but startup Sircel is one of the few players on the scene in Australia that uses chemicals to maximize the amount of material that can be extracted and minimize the amount of material that ends up in landfill. Now, what the article is really talking about is there's a circular economy aspect to this, but then there's an environmental aspect to it. There's a whole ESG thing. And this article talks about the frustration that the founder has felt because Anthony Karam tells Capital Brief the company was shunned by banks and big institutions who often proclaim their support for environmental initiatives and the circular economy. We've had no institutional or financial support from banks or major funds. So despite the policy edict around circular economy and the promotion of manufacturing in Australia, we could not get one major financial institution to support us, notwithstanding that each of them consults to peak industry bodies and policymakers. There's an anomaly in the marketplace that I think rings true, where they say that it's easier to get 200 million than to get 2 million. One of the most difficult challenges has been the inability to secure support whatsoever from major financial institution. People that say it's easier to get 200 million than 2 million haven't even raised 200,000 in my experience. But let's just put that down to a little bit of founder hyperbole, because if it was easier to raise 200 million, you just go fucking raise 200 million. But putting that aside, the big thing that jumps out here is life cycle location matters. There will be people that find things that can absolutely change the world, but you go to a big bank or big financial institution, and you're an early stage startup, like it's just not a location that they're willing to risk. You've got a whole lot of risk adverse people with a lot of systems, process and controls. And I see a lot of founders wasting a lot of time talking with investors that they don't have a chance in hell in raising from. And worse, the investors waste their time talking up all of these things and we support this space. But the reality is you've actually got to look totally different and have gotten through a number of life cycle location phases before these institutions will even think about taking a punt on you.
Yeah, I agree. And look, I don't know this company, I don't know the founder, but my interpretation of it, it's screaming of the investors don't get it. And that line was shunned by the banks and big institutions who often proclaim their support for environmental initiatives and circular economy. The vibe I'm picking up is you say you're for these things, we are for these things, therefore that should be sufficient for a deal. The world just doesn't work like that. There's much more needed to be sufficient.
Yeah, what we try and help with founders is that you've got to grow into something that has all of the ingredients for those bigger institutions to be willing to take the risk. They're just not willing to take the risk. Now, some of them go and set up corporate VCs only to shut them down a few years later because the corporate VC is infected by the conservatism, the systems, process controls, risk aversion of the big corporate, and therefore can't go and do the VC stuff. But I do absolutely have empathy for the frustration. But the reality is that you've got to look and smell like the kinds of things they're willing to back and invest. And you've got to look through all of the marketing bullshit. Dennis Wagner, one of the Wagner brothers, was at the dinner last night. They can make green concrete that's got green credentials on large projects or something. I'm going to get this wrong, but I think it was like 0.5% more, like really a rounding error more. Government won't pay the extra. Private developers won't pay the extra, right? They brought it to market and all the talk is bullshit. They won't do it. It's frustrating for them. Doesn't really worry their balance sheet, I'm sure, but they tried to do the right thing, follow all the ESG stuff, bring a product to market. It costs a little bit more because they've got to, do things around the offsetting of the carbon and all that jazz. Can't get anyone to buy it.
Yeah. I'm reminded of the Selling to Corporates panel we had in London as part of the mission, and Nicola from Boeing talking about her read of the corporate market. Unless you're solving a real hair on fire problem in the current market, they're just not interested. They're in Boeing's case, they've got doors blowing off, so that's probably where they're focused. But these
sticky tape, sticky tape sales,
duct tape on the wings. In this market, these things that are maybe nice to have, or yes, they're important, but are they driving bottom line? Are they solving the biggest problem? Are you adding real value to the company? Like that, yeah, it's a challenge in the current market.
That just makes me laugh because we talk about ESG all the time, and then the government actually won't put their money where their mouth is.
The founders that match their capital raising journey with their organizational growth journey, with the type investors that suit that phase of the life cycle, when you can get that in match, then life is still hard. It's still hard to build a business, but you're less frustrated. If you're an early stage business and you want to jump 10 steps to institutional capital, what do they say? Frustration comes when your reality doesn't meet, or your desire doesn't meet the reality of the world, or some bullshit. That's the reality.
Yeah, there's the way the world should be in your mind, and there's the way the world is. And often those circles don't overlap.
Totally. Another article that came out during the week by Tess Bennett from the AFR says Cannon-Brookes Benioff-backed startup lays off staff in a US pullback. Loam Bio, a heavily backed agricultural technology startup that has banked more than $150 million from investors, including Atlassian co-founder Mike Cannon-Brookes and Salesforce chief Mark Benioff, has laid off the majority of its staff in the US 6 months after commercial launch. Insiders close to the company told the AFR that its inexperienced leadership and undercooked sales strategy risked undermining the potential of its promising technology, which they said was showing positive early results. The fact that they've culled all those staff after over 6 months, I reckon, see that little trophy in the back there? I reckon we should mail that to them, because that's not what normally happens. I absolutely applaud the fact that they cut really hard, really quick when they realized it wasn't working out, because that's not what founders do. They blow up their capital 2 years later and then get sad.
Oh, I totally agree. I think well done on picking it up after 6 months. Well done on making the decision to cull staff, and well done talking about it. Like the fact that this is public. Like, how many of these do we see? This pattern of international market expansion, throw on a heap of staff, suddenly your OPEX is through the roof, but you keep going.
The pattern that works is small expansion, building a small machine and learning in a new market how to generate leads, how to turn leads into sales combos, how to turn sales combos into actual sales, how to activate them, and then how to retain and expand them. Success, even if you raised $1 billion, success comes from starting with one or two people. And like Vu Tran of Go One, they started to do a night shift where the founders and some other salespeople would just work 10 p.m. to 6 a.m. trying to sell into the US. Do it small, learn, test, trial, then add. There is just so much money lost to companies that say, I've got this product, it's exciting, and there's demand, and I don't go big, and it turns to shit.
Hey, Don, then for perhaps any founders that are listening that have raised capital and hired too many employees and it's not going the way it should, have you got any advice?
Cut hard. Buy a meditation cushion and do some meditation to get over your ego, and just accept that It is what it is, and you need to learn from the ground up how to communicate with customers, how to then try and turn them into leads. The problem that I see time and time again is, one, a bit of ego, because then you got to admit that you're wrong, but two, hope is not a risk management strategy. And it's always next month. Oh, we're almost there. Oh, next quarter. Oh, there's all of these great things. I'm just going to hold on to this team for a little bit longer. In my experience, if you've taken money from investors, there's a certain set of rules from the universe that wrap around you, and it's going to stretch you and test you until you make the right decision. And the right decision often is the most painful. And if you just do that straight up and then rebuild from the ground up, it's better than death than 1,000 cuts. The worst thing you can do if you've got 20 people is to cut 2 people.
Yeah.
And then cut 2 people. And then cut another person. Oh, it's not working, another cut. No. What's the minimum? This isn't working. We're in a lot of trouble. We're going to run out of runway. Bang, cut to 4. Maybe. I'm making this up. Get that burned down. I mean, Jack, you haven't mentioned Kiki in a month. So I don't know if they've hurt you or you're upset with them. But look, it wasn't working for them. Now, how they handled some of their pivot, they said they've learned some lessons, but they're building from the ground up, starting really small, building, learning, testing. That's what you got to do.
I think the other thing is attend the Growth Summit, because
Yes.
that's where we unpack all this stuff, right?
That's what we do. We try and teach founders and their investors, here's the patterns that we see, but more importantly, here's the tools and frameworks to actually guide you on it. And so you can actually build this stuff. So yes, we should pick a month where we need more rain, and then
November. Maybe that's why Mark keeps inviting us back. It's good for the property.
anything that I've missed there, Jack?
Oh, that was really good, Don.
It's hard, but it's not complex. It's actually a lot simpler than people imagine, but we go out of our way to make it complex. Now, what we were talking about in that article is obviously cutting staff and staff turnover, but staff turnover is sort of par for the course of this phase of the life cycle. And even when things are going really well, there's still staff turnover. And there was an article in AFR by Nick Bonyhady, and the article says that Canva recruits from big tech ahead of IPO, but 5 execs have left. 5 Canva executives with years of experience at technology giants, including Meta, Adobe, and Google, have departed the Australian design software company over the past 18 months as it prepares for the long run to its share market listing. The departures are concentrated in divisions responsible for selling to the large corporate customers, crucial to Canva's plans for a multi-billion-dollar IPO. The $39 billion company has been heavily recruiting experienced executives to help bridge the gap between scrappy startup and established company. However, many of these new hires did not last long in the company underneath leaders who have been with Canva since it was much smaller on the internal hierarchy. 2 sources close to Canva said that the departures represent the divide between newcomers and execs that already have the founder's trust, while others argued the company was trying to find the right executives to lead its rapid growth as it hits more than 5,000 employees.
Yeah, I think IPO is a transition, right? And they've also got the transition to enterprise sales. I think hiring people into an existing established culture at a point of transition, there's going to be turnover to find the fit.
What this article is pointing out is that people that have come from big tech companies tend to be the ones that are leaving quickly. And this is actually very typical for this phase. What tends to happen is, whilst Canva has a big valuation, you can't step over the life cycle. So it's still going to have a whole lot of early stage issues occurring in it. That's just the reality of it. Number of staff exacerbate the problem. Valuations exacerbate the problem. You just can't step over certain phases. So there's going to be certain things happening. And so then they're then hiring executives from companies that have been through all of this stuff. But what tends to happen is these executives weren't there whilst going through all that stuff. They've been at these big, cushy companies that have lots of cash, all the perks, all the systems and processes have been developed, but they don't realize that. And so they then come to something like a Canva, and it is scrappy, and there is certain ways they do things. And what starts to happen is some conflict starts to creep in. And what often happens is the old guard and the new guard, because the old guard's been doing things a certain way, they quite like it. The new guard comes in and says, we need to bring in some systems, some process, some controls. There's more efficiency here. And then what happens is the old guard goes to the founders and saying, oh, you got no idea what these people are trying to do. They're going to kill the company. They're going to destroy this. They're going to destroy that, because humans don't like change. And even Cliff himself in a number of articles keeps talking about it's wartime and there needs to be a wartime mentality. That is a certain culture and climate that does not give rise to respectful change and, hey, we've got to stop doing things a certain way. We've got to start doing things another way. And then executives that have either playbooks or have seen this movie before, at a certain point, if you've got a whole culture that's telling you, I'm not going to follow what you want to do and whatever, you just go, bugger it, I'm out. It's just really normal. What tends to happen, though, is companies don't embrace all of this new administration and change and whatever else until something goes really bang, until something blows up. Now, I'm not saying that's always the case, but it'll be interesting to see what happens with Canva, because normally change never occurs until the pain of staying the same becomes too great and they have to wait for some real painful things to occur.
I had to deliver a workshop last week for one of the VCDF accelerators on going global. And I talked about that, hiring someone from a later stage of the lifecycle company into an early stage, like in terms of hiring international people. And I gave an example from one of our portcos that recently had some experience with that. And one of the founders just had the complete fuck me moment of, you've just described my last 18 months of hell. That's why that lifecycle framework is so powerful, what you share around that. And we did have a listener write in to Jack asking actually for us to give more context to that.
I got to get that out. We should actually just put something on our website. I'll do a blog that's evergreen for people to go back to. For 60 odd years, it's been used in 80 countries. The model works brilliantly. And there's, again, coming back to what we were discussing earlier, patterns of success are a little bit of a challenge, but failure is absolutely common. And these are the kinds of things that early stage companies regularly fail at. And you end up with what we've got at the moment, a revolving door, because we're trying to attract people that are too far ahead of us at too later life cycles. And we're not implementing a process, a managerial process to handle how we go about that change. Those are the two areas where it falls apart. Now, the thing is that turnover is normal. And I know a lot of people jump up and down and there'll be articles written about the turnover. It's normal. At a certain point, it becomes abnormal. And then when it gets really abnormal, people start suing people. And there was an article where a founder is suing the Breakthrough Victoria VC fund. Startup founder Dr. Dean Freestone is suing Victorian government's troubled venture capital fund Breakthrough Victoria, claiming he was unfairly dismissed from the medical technology company he established. Dr. Freestone's claim, lodged in the Federal Court of Australia, alleges the fund and one of its officers coerced him into signing a deal to dilute his own equity in the startup he founded, Seer Medical. The former CEO claims it was threatened that if he did not agree to the deal, Breakthrough Victoria would withhold a $2 million bridging loan for Seer to pay employees and come after him personally. Taking those actions against Dr. Freestone would have been unlawful, unconscionable, or illegitimate. Breakthrough Victoria expects to defend the claim. The legal action is expected to further embarrass the Victorian government, which is standing by the fund despite growing calls for it to be shut down. It also comes at a difficult time for Seer, which is bracing for possible job cuts and the outcome of an internal investigation of potential breaches of the US Food and Drug Administration and Australia's Therapeutic Goods Administration rules, according to insiders. The Australian Financial Review revealed earlier this year that a $30 million investment in 2022 into Seer turned sour when a cash flow crisis forced the business to slash jobs. We don't know the full backstory, and that's why we often call this the cheap sheets. You can call it coercion, but at a certain point, if the business isn't going well, you're in trouble with the Therapeutic Goods Administration, the investors are not happy with you. Coercion, you can call it a whole lot of stuff, but they're going to want change and they're going to want new equity in at a valuation that reflects what's happening.
I read it twice because I'm like, what am I missing? So raise capital, shitload of staff, cash flow crisis, breaches of US FDA, breaches of the Australian TGA, failed to notify shareholders of a federal court proceeding, and now is suing for unfair dismissal. I think that's an accurate description of the article. Again, cheap seat.
The article could be wrong. We could be
100%.
misinterpreting it. The alternative is no funding, because you just, from a sunk cost fallacy point of view, there's just no point in putting in capital. But if this is a Hail Mary, save the business, and all of the stuff in the article is true, leadership change is the least that's going to be requested from shareholders.
Yeah. Yep. We could have it totally wrong if the article is missing things, and we are in the cheap seats as always.
Jack?
I have nothing more to add, but I'm sure there'll be more info to come out. So
Don't sit on the fence. This is the prednisone episode. This is the episode where I'm going to blame it on the steroid.
Summon your inner Dan Gavel. Just go for it.
Look, I think we've got to also have some empathy. It's hard. I've been a founder that presided over a company that got into trouble. I then had to guarantee against all my private assets a facility. Then we still didn't perform. Those assets got taken. The shareholders took everything. Very unpleasant, very disappointing. I put a decade in, but I fucked it up. Like, I was the CEO. That's the game. That's the accountability. And you take your medicine, and yeah, I don't know.
This kind of comes back to the conversation you started yesterday, Jack. Like, when a company is failing and does fail, but manages to get some capital back, as a founder, the question then, do you return all of that capital back to your investors who lost capital, put capital in, or do you divvy it up according to the cap table and still take something? There's some interesting scenarios that play out, and the majority of companies, like we know, fail and end up in this trough of fuckery. And so it is interesting the different reactions founders can have to it and how that manifests.
The reality is it's hard out there for a lot of companies. There's a lot of companies still cutting staff. There's revenue growth. That's a challenge. I saw a post come out saying companies are becoming more product-led. And so this is Dirk Shamler. The slump in sales efficiency is forcing SaaS companies to become more product-led. And there's a chart here that shows that in 2023, the respondents to a particular survey, 40% had PLG capabilities or were developing them, and that's risen this year to 54%. So what's happening as growth slows, they're looking for new revenue and they're going down into the PLG space. The problem is if you've got an enterprise product with an enterprise sales motion, an enterprise cost structure, and you try and make a PLG, we find big failure.
Yeah, and the episode we recorded with Tom from Blackbird about PLG for horizontal SaaS versus vertical SaaS and how that is starting to change for the vertical SaaS. And we should drop actually his post on this in the show notes.
Yeah, okay. I'll put them in. And look, it's difficult at the moment because the absolute goat of PLG in Australia being Atlassian, it had its first quarter of negative Q-on-Q ARR growth. ARR shrunk from 4.28 billion to 4.27 billion. From memory, the share price dropped significantly when that came out, but that just shows what is happening in the market.
Yeah, for context, we had quarter-on-quarter weak, but the full year results were still pretty solid. But it is, yeah, interesting.
But is this the quarter it starts to really slow, right? Yes, okay, year on year.
Yeah.
But actually, it's all about the future maintainable, right? And if this is the beginning of a real slowdown.
It's still awesome to see a $4.2 billion company like ARR growing at 33%.
Yeah,
year on
amazing.
year. Like, far out. They've had one quarter, like, far out.
And still forecasting to reach 10 bill ARR in 5 years.
Yeah.
We got a few of those as well.
Yeah. We're a bit behind budget. We hit 500,000 ARR, but trust us, 5 years from now, 10 billion.
Look at how accurately we predict our OPEX.
Yeah. I originally saw that post from Matt Aird, and he did another post where he's actually put a full report onto public company SaaS metrics. I'll just share a couple here now, but great document for those interested. But he puts like ARR per employee. You can see that Twilio generates 700,000 ARR per employee, like Zoom, 600,000. And then all the way down to SEMrush is 246,000. So if you want to know where you sit in terms of ARR per employee, that's an interesting one. Then OPEX, it's no good having great ARR if your OPEX is more than your ARR. And this shows you the OPEX per employee that starts at 725,000 all the way down to 179,000. The magic number, which is really important for companies, you can see that Atlassian, look at that, 2.34 for the magic number. I mean, that is bloody awesome. Asana, wake up to yourself, Asana, 0.05. So for every dollar Asana spent in Q1 of 24, it got 5 cents of ARR. you're in trouble down there. So there's 32 pages in here that just goes through all of these big listed companies, from revenues, ARR growth rates, average ARR per employee we've already discussed, OPEX we've discussed, magic number we've discussed, but then goes into like gross margin. What does a great gross margin look like? Now, what's interesting is Asana's gross margin is 90%, but their magic ratio is the worst. Snowflake's gross margin is 67, and Twilio's the worst with 52%.
And yet Twilio had the highest revenue per employee from memory.
Yeah, so it's possible to be all over the map, it seems. Sales and marketing as a percentage of revenue. So again, Asana was at 61, Sentinel One was at 62, and Rubrik was at 74% of revenue. That's amazing. All the way down to, say, Twilio, there's 20%, Atlassian 19%. So look at Atlassian, notwithstanding that last quarter of growth has slowed. And so we'll see what happens. They've got some bloody good metrics.
Yeah, bloody good.
Rule of 40. Viva Systems, their rule of 40 is 140. So as a reminder for listeners, you take your net profit and add it to your growth rate. And so the idea is that balances things out. If you're growing at 200%, but you're losing 100%, well, 200 minus 100 still means you've got a rule of 40 of 100. So that's good. But if you're growing at 50% and you're losing 100%, you've got a rule of 40 minus 50, and you're in a lot of trouble. But where is Atlassian? Yeah, Atlassian's up the top, 77%. It's number 3. Salesforce is 77% as well. So anyway, I'll put this report in there because I think it's really great. And it's, all models are wrong. Some are useful. All we're trying to do is provide a little bit of data on being able to benchmark, so you can sort of see what do you need to look like in order to be really attractive to investors.
Yeah, super interesting to benchmark those. I'm looking forward to going through it in more detail.
With a lot of the companies with faltering growth rates and with growth rates starting to slow, a lot of companies are looking to sort of add AI to their product suite, either to grow users or really just to retain them so competitors can't take them. And there was an article in the AFR by Tess Bennett. The Aussie unicorn is paying millions of dollars for a chief AI officer. Should you? Tech unicorn SafetyCulture is on the hunt for a new C-suite executive to take charge of the $2.7 billion value workplace compliance and safety software makers artificial intelligence program with a multi-million-dollar compensation package on offer. SafetyCulture will become one of a handful of organizations hiring chief AI officers to a new executive role, which is expected to leap in popularity as companies try to close the gap. Lucania said, founders and CEOs across the tech industry feel they need to be doing more with AI, but not everyone's sure of what they have to do. The challenge is understanding where is the value and to focus teams to go after it rather than just generating AI projects without clearly defined outcomes. Mr. Anir said it had become clear that SafetyCulture needs a standalone AI executive to unlock the value of the software firm's data set, which includes 4 billion photos taken during safety inspections. He said the AI chief would report to him, run their own P&L, build a team of AI professionals.
The other thing I picked up in the article, it would be common for chief AI officers to be paid 7-figure salaries. And the fact that their own P&L, we've talked about the impact of AI on SafetyCulture before. It's interesting. I think they have to make this move, right?
Oh, I don't have much to add there.
I've got to add something. So I meant to mention that Jake from Venue Now said in the last 2 episodes, Jack's gone very quiet, and he listens for the Jack stuff because Jack actually says good stuff. But now you've gone quiet.
Yeah. Interesting to see where we go with this chief AI role.
No, I'm editing that out. That's terrible.
Yeah, I don't know what to say. What do you?
I think just one of the little watch outs is a new role reporting to the CEO with their own P&L. That smells like all the kinds of ingredients to create big conflict inside an organization. Because what's happening is this role is then going to have a set of KPIs, a set of rewards, And often what happens is a role that's a bit separate tries to do things to others. And then people rail against it because they've got their own role and responsibility KPIs. They're busy. Change is not natural. And so in order for a role that's reporting direct to a CEO to not create huge conflict, there's going to have to be a lot of integration. The managerial process of getting everybody aligned, of aligning rewards, aligning incentives, aligning vision and mission. If that doesn't happen, a role like this can create absolute carnage. Now, Luke's been at it for, 20 years with SafetyCulture? These venture-backed things take a long time to build. And there was a post by Peter Walker of Carter said, venture-backed founders, it's going to take a decade, maybe more. Sometimes VC fundraising is a speed run. 13% of companies who raised Series C were able to do it in 4 years. Sometimes they're long grinds. 7% of Series C companies were over 9 years old. But then what he looks at, this data set, which we'll go through, is for rounds raised in the last 18 months, but he's saying that the patterns have held true for years. There are companies that start hot and then stall out. There are others that start slowly and then catch fire 5 years in. But most faced a period of wandering in the wilderness. As Paul Graham said of startups, the surest route to success is to be the cockroach of the corporate world.
I remember some data, I think it was 2013, maybe 2014, where the average time for a Silicon Valley-based startup from first funding round through to exit was 9.7 years. And I remember sharing that with founders and asking them before they heard the stat, like, what do you expect it to be in Silicon Valley? They said the average response was 3 to 5 years. And it's like, no, this is a long game, a bloody long game. And that was from first funding round. So obviously, in many cases, they've been going before that. And that's in Silicon Valley, arguably the epicenter of tech startups.
You've got to enjoy it along the way.
I love the graph of Jensen and the story of NVIDIA, like the journey they've been on and like the good and bad luck they've had along the way and the introduction of AI and how they've just gone up and to the right. And that was just purely staying in the game.
Yep. What is it you said before, Aaron? Rule number 1, don't get dead. I mean, that's the reality is staying in the game, and then you're at the right place at the right time. And some people call that luck. Fine, but actually you just stayed at it. You had an ultimate purpose, and then the universe rewarded. I'm happy for us to contribute to the averages. Wouldn't it be nice if our contribution was on the bottom side of the average and help to bring it back a little?
That'd be nice.
Well, a lot of positivity there, so that's good. Put some prednisone in the mail to both of you.
I guess for me, there's nothing new in that data. It's confirming what we know. Like it's a bloody hard, long journey.
That is Peter Walker to a test.
Yeah, here's a chart that is going to explain something that you know, but really well. Who was it? Were we talking about consultants as founders or ex-consultants? And even Harry Stebbings in his last episode, consultants as founders has a high failure rate, even though that the PowerPoint presentations look fucking awesome.
Yeah, I won't name the program, but one of the global accelerators refuses to accept consultants into the program because they make terrible founders who can't get stuff done.
Now, I don't have a really good segue for this one, but Jack, you found this and it was quite interesting. And I guess at the high level, what this article is saying, and I'll put it in there, is funds, especially emerging funds. So emerging funds that started at difficult times. And so this was using the example of post-2008 financial crisis and the funds that raised effectively in 2010 and 2011. The emerging funds that raised in those difficult times and deployed in those difficult times were the ones that just had absolutely great vintages compared to the really big gorillas. Have I summarized it reasonably?
Yeah.
Part of it says, in terms of the top decile distributions to paid in capital, the only metric that we ultimately care about, those were the 3 of the 4 top performing vintages since PitchBook started tracking this data 25 years ago. not only were those vintages the best performing in the last 25 years in terms of top decile DPI on an absolute basis, but 2010 to 2012 ranked 1 and 3 in terms of the delta between the top decile and the top quartile in a particular vintage. And they were 1 and 2 in terms of the delta between the top decile and the median. Said another way, at market bottoms, the best funds outperform relative to the rest of their peers, but the average managers don't necessarily do the same. This underscores the obvious importance of manager selection and highlights that the quantum of outperformance is even more pronounced during periods of market turbulence. So, as you would expect, choosing the right manager is obviously a key step, but the broad thing is it's the emerging managers back during difficult times that have produced great results. Put your hand up if you're an emerging manager during a difficult time.
It's us.
Yeah, like it's just a good reminder for us, and that's why I sent it in. Like, a hard time to raise is a good time to invest, and a good time to invest is a hard time to raise. So it's just where we are right now. It's a bloody good time to invest. We've seen really good deal flow, but the flip side of that is we just got to grind and be the cockroach and do whatever it takes to get the minimum fund squared away.
Oh, 100%.
Yeah, absolutely.
So let's wind up before charts. I found this, which I thought was funny. These are the 10 startup lies. I'm a Forbes 30 under 30. What it actually means is I paid a PR firm 50 grand so my mum could be proud of me.
Whenever I see that, or the 40 under 40, it's like, oh. Anyway.
Now, one of the comments said, I paid 100 grand and my mum still thinks I'm a failure. We decided to raise less money for this round because we don't really need it. Translation, we did a down round and now I only own 5% of the company. We have a highly experienced advisory board. Translation, a few industry experts agreed to have coffee with us once. Our sales team are crushing it. Translation, about 25% of our sales team hit their quota. We've been developing our own AI for years. Translation, we use ChatGPT and have a nice UI.
Some of these are hitting close to home. Oh.
We have a very disruptive business model. Translation, we're not actually making any money.
That is odd. That rings true. For a cold inbound pitch deck, that is way far too long and far too confusing for me to understand.
What's the other? It's I don't think he has it in here. We're in stealth mode. Translation, we've got no business model, no product, no customers, no anything. Our burn rate is under control. We're running out of money, but we're trying to sound optimistic.
Hey, Don, the last one's the best. You got to read the last one.
Okay. We've grown 100% month over month. We have 2 users now. Last month we had 1.
Yeah. Oh, man.
Oh.
Look, we shouldn't be so rude, but it is.
We recognise it's bloody hard, but
true.
far out.
Yeah.
Hey, Don, you can edit this out, but this is like, hey, US expansion has grown 190%. So we want a 15x multiple. It's like you've grown from 5 users to 10, man. What do you mean?
Oh, fuck.
Yeah. So, yeah. We understand how hard it is. If ChatGPT was to run over this, the summary would be the Tribe team mocks their main ideal client. We're not trying to do that. Another one that I saw in the comments, we're going up market. It actually means we haven't nailed our ICP yet, so we've decided to hunt whales in the hopes that they can pay our bills.
Spot on.
That is so spot on. Should we get into some charts?
Yep.
So the VIX, we spoke about the VIX, and this is where trading the VIX, you've got to be so careful. So the VIX spiked from like 10, 11, 12 up to 65, and then within days is back to 20, which sort of aligns to my previous thought that this is just one of the natural pullbacks. And I found this, which is just a little chart from Variant Perception, that after these big VIX spikes, you just got to be really careful. So what this is showing an oscillator that's getting less and less over time for those listening at home. And what they just point out is be careful buying the dip when it's been a really big dip with a lot of volatility too early, because what happens is it goes up and down, up and down, up and down until it stabilizes. And they put some examples from different market periods where you had the big high volatility crash, and then it went up and down until it formed a proper low, and then the new highs could start. But maybe Warren knows something we don't, because this is Warren's cash pile. He sold half of his Apple holding plus a whole lot of others. And just have a look at that up and to the right, like 105 billion in cash, now 277 billion in cash in a very short period of time.
Yeah, wow.
And keep in mind, his model is to sit on a lot of cash, so then when everybody shits the bed, he can go in and buy them cheap.
I forgot to send it to you, Don, but someone did a correlation of the number of times a company gets mentioned in Buffett's letters to the value of the company, and using it as a predictor of which direction a company is heading in. I'll shoot it to you.
Yeah, all contributions welcome. Sounds a little bit too value add though, Aaron. Now, one of the things that credit spreads have started to spike in the high yield. They've gone from 302 up to 393. So it's only early, but it's the credit market that when it starts to spike, all hell breaks loose. So that's really what we've got to be keeping an eye on. I'm going to go do some research on a few credit spreads and see if I can find some YOLOs. And this is just a data set from the last 3 recessions in the US. All saw credit spreads move over 1,000 bips at some point. We're not even close to that scenario today, with the credit default expectations remaining low. But it just does show that when things do spike, like the GFC, they spiked 2,182 bips. In other screw-ups, it's been 800, 900, 1,000. That's the market that I'm keeping an eye on. Now, in the US, this is a chart for those at home, foreclosures. If you look in 2008, this is the volume of commercial properties held by lenders by value. So have a look. This starts like 2006 when there was nothing. The GFC comes along and that goes from 0 up to 45 billion. Then 2012, it starts to work out at the top of 45 billion and drop. And it hit a low in 2020 of about 9 billion of commercial properties held by their lenders. But if you have a look from 2021, it's gone from 10 billion to just over 20 billion now. So interest rates rising, commercial property defaults. I don't know if there's a huge correlation, but if lenders are taking over their properties, it's generally not a good thing, I would have thought. And the delinquency rates of CMBS office loans, so this is loans on office buildings, you can just see from 2022, the delinquency rate went from 1.8%. We've now hit 8%, right? That is just up and to the right for this modern era. Now, where it peaked out in the GFC was 10.5%. So we've still got a little way to go. But again, delinquent credit going up and up month on month is probably not a good thing. And the other delinquent is credit cards. If you have a look at that, we've started to see a bit of a spike in the last few quarters. Now, you know who doesn't have a credit card delinquency problem? Alan Joyce, former CEO of Qantas. This is a chart that shows all the money Alan earned whilst at Qantas. So it reached almost 120 million for the, 14 years that he was there. But then he's had 9 million of that roughly clawed back for over-optimizing the airline and driving its brand into the ground. So at least there was some little bit of consequence there, but I have a feeling he'll still be able to make his credit card repayments.
I think he's done all right.
Yeah, wow, that's a lot of money.
Yeah. Foxtel's for sale. So this is a chart on the left here that shows the number of subscribers of Foxtel Now, Binge, and KO. And Foxtel has just been dying. Like it's gone from 2 million subscribers to about 1.2 million subscribers, just dying down. And revenue and EBITDA, they've managed to keep EBITDA pretty flat. So they're obviously optimizing the shit out of everything in that place, given revenue's fairly flat. But it's on the chopping block. And so probably some PE firm's going to come and buy it and try and financially engineer itself into a bit of a profit. But Binge, I didn't realize Binge since 2020 has gone from like no subscribers to nearly 2 million. And KO has gone from like a few 100,000 to over 1.5 million. The total pie has grown, but they've eaten a lot of Foxtel's lunch. Now, in Australia, are we heading into recession? I'm not so sure. It's just too buoyant. Interest rates are far too low for the current situation. So this is mortgage stress in Sydney. This is looking where a couple could buy a home using less than 30% of their income on a home loan. In 1994, 67% of suburbs in Sydney could have been purchased with less than 30% of your income spent on interest. Today, it's 19%. 10 kilometres of the CBD in 1994, 31% of properties could be purchased with 30% of your income or less. Now it's 3.8. People sitting on large property portfolios have ridden properties just getting a lot more expensive relative to income. And so here's just some random charts. In 1994, you can see the light blue is 0 to 15% of your income. The next blue is 15 to 20%, orange 20 to 25, darker orange 20 to 25, and 30 plus is red. You can see there's a little bit of orange, a little bit of red. This is in Brisbane, actually. But you can see that there's a lot of blue there. Whereas now, have a look at that. It's all red and orange. And maybe if you're willing to drive 2 hours from the city, you can get something for less than 30% of your income. Sydney's the same, right? Have a look at 1994. It had a lot more red back in 1994 around the harbour. That makes sense. But now the whole place is fucking red. Good luck. So this chart here, going back to 2019, this is just the median days on the market. If pre-COVID, it's sort of started to rise to 60 to 70 days. Then at the low, it's like 39 days. And we've only just marginally gone up to 43 days. So houses are still moving very, very quickly, as Jack has found. But it's not all equal. If you're selling a place in Darwin, the average is actually 75 days. And then other places are like 41, 40, 39, and 30-ish days. So depending on where you live, it depends on the demand, which makes sense.
I'd like to see the data for Cairns. I need to get the latest figures. I think it's somewhere between Darwin and Brizzy on the chart.
I love the fact that soon Jack's going to be doing podcasts from his own office.
Yeah, I can't wait.
Now, so this is a chart that shows the share of 25 to 35-year-olds living with their parents. So we're only just reached the same percentage of 25 to 35-year-olds living with their parents, the same as 1940.
Oh, wow.
Then 1950, it drops to 12%, 1960, 8%, 1970, 7%. And then in 1980, it starts to rise again, 8%, 1990, 11%, 2000, 10%, 2010, 15%, and then now 17%.
It was 1940 off the back of a tough period.
Yeah.
For the economy.
Yeah, no, that's true.
So
I would like...
I think if that went earlier, it actually would have decreased and then risen, like just when the economy gets tough.
Yep. No, that's a valid point. I'd like to see a chart of entrepreneurs that have had to move back in with parents after a fuck up.
Yeah.
And I think that's higher than you think.
Oh, so I know I haven't touched on Kiki, but that's a good point to chime in. So Toby signs off on his investor updates and it's like going homeless or going somewhere. I just love that.
That's it. There's someone that's got perspective.
Yeah, I love it.
Now, the Olympics is over, but a couple of ray gun memes. Our fearless break dancer. So this one, what my nephew does after telling us all to watch this, and it's some of her moves. And then someone else posted, insane respect, got all the expenses paid trip to Paris, plus all the free gear, and is forever Olympian. She cooked hard here, I'm afraid.
Jeez.
I think that's all I got.
Good shots.
What are we looking forward to?
I was going to say not getting sick despite a household of sick people.
At least you'd rather get sick this week, Aaron, than next week. So
True that. Well, no.
Don't get sick.
I am excited. Marin's parents land from Germany on Monday, so that'll be nice to have them in town. What about you boys?
I'm looking forward to getting the win in the semi-final.
Yes.
Well, next week will be that'll suck.
I want to see a video of you like on your team's mate's shoulders and then yelling at the camera, this is for Aaron and Marin.
Yeah.
That's if we win the GF. Okay? If I do that on the semi-final, that's embarrassing.
What about you, Don?
Yeah, well, we're supposed to be doing a whole lot of concreting and plumbing and trenching, and all of that has washed away. And trying to be ready to not embarrass myself by hosting a function on behalf of Tribe. So there's going to be a fair amount of time on the excavator, I think.
You love it.
I'll put up some shade cloth or something to hide my shame.
We've got to get you back up here, Jack. Got to book you in for... You should come up on the 2nd.
What's on the 2nd?
The Tipman event.
Oh, okay. I thought that was on the 7th for some reason.
Fuck, I hope not.
So then, yeah, and then I'll stay up until the Broncos.
Yeah, sweet.
Is that the plan? Was that on the 6th? That's maybe where I've got my dates wrong.
That's on the 5th. So the
Fifth,
idea
okay.
was if you stay up until the 5th.
Yeah, cool. No, that'll be perfect. I can stay at my brother's. Like, that's no issue.
Great. Look at that. Part podcast, part admin.
Yeah.
Really showing how the sausage is made in this place.
We're nothing but transparent.
All right. It's also a public holiday here, so I'm going to go and play with the kids for a bit and then get this edited. All right. Let's see how we go. All right, lads.
Sweet.
See ya.
Thanks, boys.
Hey.